The German Mittelstand has long been core to M&A activity in Germany, and here to talk a little bit about some of the developments that are taking place in the German Mittelstand is Sarah Syed, private equity correspondent for Merger Market with a particular focus on Germany. Sarah, talk to me a little bit about some of the developments that we're seeing in the Mittelstand that make it so attractive, particularly from an advisory point of view.
I think it's no surprise to say, or to anyone to say, that the mid-market is still a strong area of growth, and it attracts a lot of international and domestic players to the market. It's interesting from an advisory perspective because they see that these companies, they've shown sustained growth. They're a bit more conservative in their growth plans, which means that they maybe have less debt in the company, which makes it easier to potentially sell or grow the business in the future.
So Sarah, talk to us a little bit about how the relationship between the advisory market and the Mittelstand is changing at the moment.
I think in Germany, bulge bracket banks are clocking on to the fact that the Mittelstand is what really drives the German market. If you look at banks like Goldman Sachs, they're pitching for smaller sized mandates, including a German toy maker called Schleich. It's a private equity owned business with about 200 million euro turnover. These are the types of assets that drive the market and make it attractive for advisors to get involved. Goldman Sachs also advised on a smaller sale last year of a retail company called Schusterman & Borenstein. The EBITDA multiple figure was about 25 million, and it's much smaller than the size that they would usually go for. So it just goes to show that the bulge bracket banks are shifting more into the middle market, and the middle market boutique banks are still, there's a lot of M&A going on, so there's still a lot of business for them to do, but they also might start looking at the smaller size deals as well.
Okay, thank you very much for that, Sarah.